Hi friends, welcome back to the channel. Today we are talking about the rupee. Rupee falls to an all-time low against the dollar. Sounds familiar? Seems like every other day. And the RBI. Their name keeps popping up. Are they doing too little, too much? Depends on who you ask. But seriously, what does it all mean? Why does the rupee fall? Why does the RBI get too involved? This whole thing, it's a weird controversy, crucially important for India and the market, but also super niche. Honestly, maybe only 3.5 people truly get it. So, we are going to simplify things for you. We will break it down. To get us started, here are 5 big ideas. This will get you up to speed on currency market. Idea 1, currencies. Think back. There was a time when currencies had a real value, linked to gold usually. The gold which is in country's bank. But that system, it broke down. Over the last century, completely gone by the early 1970s. Since then, for 50 years now, currencies have no innate value. They are worth something only because we believe they are. Sounds chaotic, right? Disastrous even. But somehow, this weird system, it survived for decades without too much chaos. Idea 2, Forex market. This lack of real value, it's a challenge. Anytime you buy or sell a currency, especially across the border, you need a price. Imagine you are importing chocolates from US for $10. The seller, they only want in dollars and your money is rupee. Now you need to convert your rupees into dollar. Here is the problem. Both currencies are based on belief and no real value underneath. Luckily, we have foreign exchange market. They give you an exchange rate, a price to convert your currencies. Idea 3, exchange rate, supply and demand. Okay, so how do exchange rate actually get set? Remember supply and demand, just like anything else. Let's see some examples to make this crystal clear. Example 1, chocolate import. You are importing chocolates from US. You need dollars to pay and you have rupees. What do? You go to forex market. You are asking for dollars. You are giving up rupees. In market terms, you demand dollars and your supply is rupee. So basically demand for dollar goes up. What happens to dollar price versus rupee? It can go up. Example 2, remittance. Someone works in the US and sends money home to India. They earn in dollar. Their family needs rupee in India. So they go to forex market. They want to turn dollar into rupees. They are offering dollar and they want rupees back. So in market terms, they supply dollars and demanding rupees. So demand for rupee goes up. What happens to the rupees price versus dollar? It can go up. So key takeaway from this example, every time someone wants to exchange currency, it impacts supply and demand. Idea 4, impact of exchange rate on business. Exchange rate aren't just number. They change real thing in the economy. Let's use a shoe factory to see how. Imagine you are a shoe factory. You export shoes, sells them for ₹1,000 a pair, and your customer is in US, so they will pay you in dollars. When you started, $1 was 80 rupees, so your shoe in US costed for $12.5. Now, let's consider two scenario and watch out what happens to your business. Scenario 1, rupee appreciates. Rupee gets stronger. Now $1 equals to 70 rupees. So what happened to your shoes? Still costs ₹1,000 to make in India, but now in terms of dollar, they are more expensive for US customers, over $14 a pair. Now you didn't change anything, just the exchange rate change, but your shoes are more expensive in the US market. Scenario 2, rupee depreciates. Rupee gets weaker. Now $1 equals to 90 rupees. So your shoes still ₹1,000 in India, but now in terms of dollar, they are cheaper, and customer will pay $11 a pair. Again, you change nothing in your factory, but your shoes are cheaper in the US market. Here is the main point. Exchange rate changes how competitive your business is internationally, and they affect prices back home too. Idea 4, markets. Forex markets are active because of real business, trade, remittances, investment, and all. But there are two other players who drive market. One is speculators, so they bet on currencies more and uses option, leverage, and all sort of tools. Second one is central bank, like RBI. They buy or sell their own currency and create artificial supply and demand, which pushes the currency where they want it to go. Now, let's dive into what's been happening recently. So, post COVID, dollar prices rose exceptionally high. compared to most of the currencies. There are many reasons for it. World economy shows weak sign since COVID, whereas US economy showed good real GDP growth and tight labor market. Investors are scared. For them, investing most of the places is too risky. So they want to park their money in safe US market. And because of this, money poured into America in past few years. You can see it with the rupee. Rupee falling against the dollar to its all-time low, which is 86.5 per dollar. But here is the thing. Compared to other countries, rupee hasn't moved much. Most of the currencies fell harder against the dollar. But why? There is one reason for it, and it's RBI. RBI played big role in guiding the rupee's price. Here is what they did. In short, when foreign currency comes into India, RBI bought a lot of it and kept it as a foreign reserve. Otherwise, all that money would have been exchanged for rupee and rupee would have gone higher. Rupee price falling too fast, RBI defended it by selling those foreign reserve and buying rupees. You can see there is a big swing recently in India's foreign reserve. RBI has always done this. Other central banks, especially emerging market, also do this. But RBI ramped up activity after August 2022 and now we can see the result of it. Rupee dollar rate barely moved since. For many people, they feel like RBI has fixed the rate and won't let it move. And that's worrying because exchange rate matters for the businesses. When RBI keeps rupee too high, we are less competitive exporter. Vietnam, Indonesia win contract instead of us. When rupee is too low, exports get expensive. Oil, steel, and essential prices rise for everyone. Economists say market find the right price by supply and demand balance. When anyone interfere in this, things get weird. Economists pointed out RBI's action created a weird situation. Cheaper to borrow abroad than from Indian banks. So companies borrowed abroad and replaced Indian loans with foreign loans. As they repay those loans, rupee could fall even lower. Markets don't always reflect the real economy. Similarly, speculators, their bets don't reflect the real trade. Small moves cause big crises for emerging market. We have example like in 1997, which is Asian financial crisis. Lenders panicked about Thailand and caused chain reaction. And result of it, East and Southeast Asia went into crisis for years. And because of this, many countries always watching the currency market closely. As per RBI, they are doing intervention to stop volatility, not to fix prices, just to smooth out spike and dips. But investor, here are three big takeaways. 1. Don't get emotional about the rupees price. These moves are part of system. Better to have a low prices than a wrong price. Second, exchange rate changes everything. Trade, investment, inflation. Understand these effects. Spot opportunities and risk. Exporters benefit from a weaker rupee and importers face cost pressure. Third, big player in currency market, the RBI, ready to spend big money to keep things balanced. Remember that when you invest.